$8 trillion is the amount of cash sitting on the sidelines right now. Just how much is 8 trillion? It's enough to equal the combined GDP of 3 major countries. It's so much that it exceeds 1/4 of the current economic value. So what does that mean? It means that right now, there's a massive amount of money sitting outside the market, enough to crash it, or conversely, enough to send it to the moon. And what does that depend on? It just depends on whether investors decide to pull that money out of the market or dump it back in. And the deciding factor is even simpler. It's just a matter of whether you're richer holding cash or richer by investing. And in this video, I've explained everything like, hey, if you want to know how to tell if holding cash is more profitable, or hey, will putting money into stocks make you richer or poorer? It's all there because honestly, right now, the stock market isn't hard to read at all. The only stock carrying the whole world right now is in the AI industry, and the center of AI is still held by only a few companies. In the last video, I talked about NVIDIA being the center. In this video, I will talk about OpenAI, which is another major center. Whether it is a disaster or a triumph, you will have to watch to find out. And in this video, there is an important keyword I want everyone to remember. Whether something is a disaster or a triumph does not just depend on having more money. It also depends on the critical keyword growth rate, because this growth rate, it was the starting point of the 2008 financial collapse. I've compiled all of this for you already. I guarantee it's easy to understand, step by step, and well organized. Let's take a look. You can support the Try Money Monster channel via this QR code. Feel free to scan it. Or it's very easy to support my channel. Just leave a comment and chat with me. Hit like, share, or if you haven't subscribed yet, come on, hit that button for me. And if anyone wants to support me long-term, you can become a member. There are even cute emojis available for you to use now. Thank you. Let's start with the $8 trillion in cash that I mentioned is sitting outside the market. Where exactly did I get this data? I got it from this chart, US money market, because it's the closest thing to cash storage, let's say. It's not cash like in a bank account, because if you keep your money in a money market fund, you're essentially parking it there. You can withdraw on a T+1 basis, meaning you get funds within 1 day. Money market funds are essentially short-term bonds. As you can see, the amount of cash sitting in money market funds outside the market is significant. Has shot up very steeply. It's risen to $8 trillion. You might ask, how big is $8 trillion? It's enough to equal the combined GDP of France, Spain, and Russia. And this $8 trillion actually accounts for more than 1/4 of the size of the economy. It's huge, which means this is a massive amount of cash outside the market, right? It has enough power to make the market crash or skyrocket significantly. Another statistic I want to show you is the amount of cash that surged before the recession. See, the red line is the amount of cash that surged before the recession, just like the last 3 times, before 2000, before 2008, and before 2020. Editor, please highlight the cash line that surged as well. And you might ask, why does the cash line surge? It's because money from major financial institutions, or what they call smart money, I guess you could translate that to clever money in Thai, they're cashing out and holding on to their cash. Yes, they cash out and hold on to it every single time before the market crashes. And let's look back at this chart again. We can see that the proportion of cash outside the market, which is as high as 26% of the economy's size, is higher than it was during the last 3 recessions. Hold on, friends. Don't sell just yet. Don't short, don't close any positions right now, because the information I just shared is only one side of the coin. That $8 trillion sitting outside the market right now doesn't just have the potential to crash the market, but as I said, it's also possible that it could send the market to the moon. If only this pile of money has the incentive to re-enter the market. So the next question we need to find the answer to is, what determines whether this money will dump or return to the market? And the incentive really just depends on whether holding cash yields a higher return or if putting that money back into the market to invest offers a better chance at higher returns. So let's look at whether cash or assets will provide a higher return, right? Let's look at the cash side first because I think it's easier. It seems much simpler, right? Because if we look at the cash side, we can just check the 3-month US Treasury bond yield. On the day I wrote the script, which was August 13th, the 3-month US Treasury bond yield was at 3.8%. So it's high, but just average, not super high. There's still a chance, right? And this yield figure for the 3-month US Treasury bond can be used as a benchmark to see that if we hold cash, our return should be around this much. Because as I mentioned at the beginning of the clip, the cash that big investors hold isn't kept in a bank account. They keep it in a money market fund, which is the closest thing to cash, so it can be compared directly to the 3-month short-term US Treasury bond, because you can withdraw it immediately. Now, we want to know whether cash or stocks provide a higher return. Let's compare the two lines. The bond yield is the return from short-term US Treasury bonds, or a proxy for the return on cash. I've set the bond yield as the red line and the stock yield as the white line. If the red line is significantly lower than the white, cash returns are much lower than stocks, so money flows into stocks. Conversely, if the red line rises near the white, returns are similar. Investors might think, why take the risk in stocks? I can just keep my money in cash and get a decent return without the hassle. Wouldn't that be better? Or even worse, the red line overtakes the white. This means cash returns are higher than stocks. It's a clear sign money is flowing out of stocks. So the next answer we need to find is, do stocks currently have a tendency to provide high returns? Or is there something hidden that might be causing smart money to pack up and flee the market? The good news is that finding the answer right now is very easy because the only industry carrying the entire global economy is the tech industry. Let me give a quick warning here for those who think they've diversified their risk, specifically those who say, I hold S&P 500 stocks, so I'm diversified. That just doesn't cut it right now. It's not, because 40% of the S&P 500's valuation is made up of tech and AI companies. This means that if you say today that the majority of your assets are in the S&P 500, I'm sorry to say, you are actually highly concentrated in your risk. You're not diversified. Anyway, let's continue. So let's move on to the risks associated with tech stocks. If you watched the last clip, I explained that AI stocks are hiding $1.65 trillion in debt off the balance sheet. NVIDIA was the center of that potential damage, but in this clip, let's shift the focus to OpenAI. What has OpenAI actually done? Nothing. They haven't generated any profit since OpenAI was founded. They generate $20 billion in revenue, but they burn cash. Why? Because OpenAI's growth valuation still looks good. That's why they've been able to raise so much capital from investors. They take the capital they raise and use it to buy future computing power, which means buying data center capacity from companies like Google, Microsoft, Amazon, and so on. And these companies then record that amount as future revenue. This allows these companies to use that future revenue, or backlog, as collateral to take out even more loans. And just to reiterate, that future revenue that those companies recorded as backlog and even used as collateral for loans is revenue from companies that have never actually made a profit. So how did this happen? Well, it's like this. Last March, OpenAI just raised the highest amount of funding in history, $122 billion, bringing the valuation of OpenAI up to $852 billion. It's a huge amount. Oh, and where did this investment money come from? Well, it came from fundraising from investors, despite the fact that OpenAI has never made a profit. What do these investors see? They might see that, hey, the value of OpenAI just keeps going up. How much? A lot. Let me show you. In 2024, investors valued OpenAI at $86 billion. By October 2024, it jumped to $157 billion. By March 2025, it hit $300 billion, and by October 2025, it reached $500 billion. And this past March 2026, it was reported that they raised an additional $122 billion, bringing OpenAI's valuation up to $852 billion. Now, this valuation is just an estimated amount, right? I want to show you another graph. This graph is very important. It shows the growth rate of OpenAI's value. Okay, bring up the chart. Here we go. You can see that ever since OpenAI was founded, it has continued to grow. There have been a few small dips, but the important thing is what happened over the past 2 years, from 2024 to 2025. It grew 1.7 times from 2025 to 2026. It grew 1.9 times. This means that in the last 2 years, it has grown. As long as this bar keeps growing, it's a green flag. Investors see this and still feel like, hey, it's still worth putting more money into. And like I said, right, once OpenAI raises capital, what do they use it for? They use it to buy computing power, which is a future expense. But I'm telling you, this game isn't just being played by OpenAI alone. There's OpenAI, Anthropic, and others. Let's just say there are 3 main players who have raised capital and are using it to pay for future computing power. This has led to cloud computing purchase contracts for future capacity totaling as much as $2.1 trillion spread across major companies, $460 billion with Google Cloud, $638 billion with Oracle, $625 billion with Microsoft, and $364 billion with Amazon. As you can see, every company has designated this as future guaranteed revenue, or what we call a backlog. And every company is using this as collateral to borrow even more. What does that mean? It means that if OpenAI, Anthropic, and other companies have the ability to raise more capital or generate profits, they can use that to pay off the revenue that all these companies have already recorded. Actually, nothing will happen, but if they can't raise capital, or if they raise less than before, it will turn into a chain reaction of disaster. And what would cause them to be unable to raise capital is if their ability to raise funds isn't fast enough. Get it? Look back at this bar again. From 2024 to 2025, OpenAI grew 1.7 times. From 2025 to 2026, OpenAI grew 1.9 times. If this bar keeps moving up, that's a green flag, and investors will put money in. But if the next bar doesn't go higher, well, if it's just a little shorter, that's not so bad. But the moment it gets significantly shorter, that's when you've got a problem. Especially if it drops for 2 bars in a row, I'm telling you, you can start counting down to disaster. And just so you know, I didn't come up with this theory myself, but it's actually a comparison to historical theory, specifically back in 2006, the pre-crisis period before the 2008 crash. And why? Because in 2006, home prices were still rising, just less than the previous year. The first bar in 2006 was lower than in 2005. The second bar for 2007 was still rising, but less than in 2006. The third bar for 2008 was still rising, but less than in 2007, and then it crashed. That's what led to the subprime mortgage crisis, or the hamburger crisis of 2008. So what was the problem with housing prices still rising, but not as much as the year before? To make it easy to understand, let's visualize it. Look at this bar graph. If housing prices don't jump up as fast as they did the previous year, it means this bar can't cover this one, which means the new debt can't cover the old debt. And that's what made the economic figures unsustainable. And if it can't cover the old debt the first time, the second time, the third time, it collapses. That means in 2006, housing prices were still rising and demand for homes was still increasing. The demand was there, but the economic figures were unsustainable because the acceleration was gone. And if you wonder what other variables caused that acceleration to vanish, internally, failing to find new debt to cover old debt, or failing to generate profit, these are the variables that cause all acceleration to vanish. The most importantly, that variable doesn't just come from internal factors alone. It also comes from external factors. Right now, those variables are extremely strong. That would be China, a factor America has always overlooked. Let me tell you, since 1990, China has taken over the furniture market. Toys and cheap, flimsy goods, right? What did analysts say back then? Cheap labor. And then by the 2000s, it wasn't just cheap toys anymore. It was shipbuilding. It was the steel industry. Back then, some analysts were still saying it was just a coincidence until 2024, 2025, 2026. And what's happening now? Wherever Chinese EVs show up, national companies in Germany and Japan are getting crushed. What's next? Monopolizing rare earths. You can't produce technology without them. Then there's solar cells, which China has also monopolized. China dumped glass prices to the bottom. China slashed solar cell prices by 80%. Germany couldn't survive. And everything America has overlooked until today? None of it was a coincidence. Everything was written in China's 5-year economic development plan, and it was even made public. For those who haven't watched this clip yet, go check it out. And you might ask, what happened today? Last year, China released DeepSeek, which really shook up the AI world, right? And just recently, on July 16th, an AI lab called Moonshot released a model named Kimi 1.5, and it was released in just one day. It became #1 on the coding leaderboard, so everyone is really keeping an eye on it. And it was able to beat the best models from Anthropic and OpenAI, all at a cost that's 40% lower. And what's just like, wow, is it really that good? I mean, 11 days after the launch, Moonshot released this model, Kimi K3, for free download. Anyone who wants it can just go download it. So people started asking, is Kimi K3 really that good? Is it really that much better than the American models? Enough to take down America? The answer is no, it's not necessary. Kimi 3 or Chinese models in general don't need to be better than American models. Just being almost as good or almost free is enough. And right now, Kimi 3 is both of those things. Because if you ask yourself, as an AI user or an entrepreneur using AI, if one model is, wow, it's so expensive, it keeps raising its prices on me, versus another model, it's also good, almost the same, but way cheaper. Honestly, which one would you choose? The answer is already in your heart. So on the same graph, OpenAI grew 1.7 times. 1.9 times. This is still good, but now there's a problem because there's a new forecast that in the next round, OpenAI's fundraising won't be as much as before, which might cause OpenAI's growth bar for the next period to shrink down to 1.2 times. Let's mark that in red. This means the new bar isn't as impressive as before, and American AI, which is at risk of slowing growth, might also be at risk of defeat. Before I go on, I need to add a disclaimer. What I've been talking about needs to be separated into business numerical possibilities versus AI technology. If you're asking, hey, is AI actually for real? Is the technology good? You shouldn't even have to ask. It's genuinely excellent and a truly positive development. I use it every day, like ChatGPT. I honestly can't live without it. But even though AI is a real thing, if the economic numbers don't add up, they don't. Back in 2008, when everything collapsed, the demand for housing was still a real thing. The business numbers didn't add up back in 2008, so it collapsed. After listening to this clip, don't just blindly believe there's only one side to the story, or that this is the only incentive for smart money or financial institutions to pull $8 trillion out of the market entirely. There could be other factors that I don't see. I put a lot of effort into making this clip. I researched this, but it seems this is the case. If you've looked into it and found other factors, there's this factor that might be the incentive for investors to want to pull that $8 trillion back into the market, and it could end up going to the moon. That's still a possibility. But the takeaway here is, when looking at AI companies, don't let them fool you just by saying, hey, we raised a lot of capital. It's common because everyone wants to invest in AI. It's a lot. If you're asking if it'll exceed last time, the total could be higher, but I want you to focus on the rate of acceleration. Can it still accelerate faster than before? It was 1.7. At 1.9, if the next bar is 1.2, flag it red. If it drops even lower than 1.2, mark it. This has the potential to be a countdown to collapse. Another important thing is, don't let the backlog numbers or the revenue that's guaranteed in the future fool you.